Welcome back to the fifth video of our series From Zero to LBO. In this video, we will capitalize on the hard work we spent building our integrated and dynamic three-statement model of Twitter to build a simple yet fully fledged leverage buyout model. The LBO model benefits from the flexibility we have in our operating model and adds additional variables and assumptions to give us a handy tool to analyze and evaluate the future development of Twitter in light of takeovers, like for example, Elon Musk's takeover. So let's begin. We start off with the DCF model we built in our last video and define the overall assumptions of our leverage buyout in a new worksheet SAU, which stands for sources and uses. So the worksheet is, as always, built on our template we defined in our first video. And first of all, we define a date when the LBO will take place, and most importantly, we calculate our enterprise value or assume the entry valuation for our contemplated leverage buyout. At this stage, just a brief caveat. In this video, we are using dummy numbers to illustrate the technical setup of the model. We will analyze the financials and real-world implications of, for example, the recent acquisition through Elon Musk in a future video. But for the moment, please remember that the figures presented here are just random numbers. So after we calculated the enterprise value as the product of our defined multiple and the EBITDA of the year we are performing the LBO, we calculate the purchase price. The purchase price calculation is a simplification, of course, as in the real world, the price you pay is very crucial in defining your return. And as always, the cheaper you buy, the better the deal, or to be more precise, the better the returns. However, we already discussed other approaches like a DCF valuation in our previous video, so please wrap your head around a decent valuation for Twitter. For the moment, we just rely on an EBITDA multiple. So after the EV calculation, we bridge the EV to equity value to arrive at the purchase price, which is the equivalent of the equity value in our case. To arrive at the equity value, we have to take into consideration any debt and cash-like item. The identification of these items is crucial and typically subject to negotiations in LBO or M&A processes, bank or other interest-bearing liabilities that bear an obligation in the future are of course not that disputed in negotiations. However, other items like pensions or CapEx backlogs could lead to discussions. In case of listed companies, even outstanding options should be analyzed. So maybe we can make another video on these topics, equity value bridge in the future. Please leave a comment if you are interested in such a video. So looking back at Twitter, we link all interest-bearing debt and cash, including short-term investments, to the bridge to arrive at an equity value. Next, we add further assumptions for financing costs which are associated with the leverage we will introduce in a minute, and other fees like M&A advisory, legal, or tax advice. We will see also in a minute how these costs and fees are incorporated in the LBO model. But for the moment, we add a management fee So this management fee is typically charged by sponsors or private equity funds for managing the company. Typically, the fee is calculated as a percentage of the committed capital, and this percentage is usually around 2%. However, for the moment, we stick to this hard-coded fee as a plain assumption. Finally, we calculate the goodwill of the transaction as a simple difference of purchase price and the book value of equity of the respective year, in our case 2022. Please note that this is also a simplification, and you should always consider local GAAP when calculating goodwill or performing a purchase price allocation. For our purpose, this estimate is sufficient. So up next, we build our sources and uses schedule. The sources and uses are straightforward in defining how much capital is needed to finance the transaction. So on the one hand side, we have an overview of the capital needed to conduct the transaction, and on the other side, we define the components or structure of the capital to realize the transaction. The variety of the sources or instruments used to finance the transaction are quite diverse, ranging from super senior facilities to equity-like instruments. As I said, regarding the purchase price, the success of an LBO is defined at every stage: acquiring the asset, financing the asset, managing the asset, and of course, exiting the asset. Therefore, the financial structure is also a key part here. The history of LBOs reveals the creativity of financiers in structuring successful LBOs, creating junk bonds or syndicating loans, all in the light to maximize leverage. So we will see what the future brings in terms of financial structuring. In our case, we start, of course, with defining the uses, and the key use of the capital is, of course, the purchase price, which is just linked to the above calculation. Next, we assume that the existing capital structure is refinanced, so the existing debt of Twitter is repaid. And in addition, we consider financing costs and fees to arrive at the total uses. Next, we define the sources, and here we start off with the existing liquidity at Twitter, which we also included in our purchase price calculation. So we assume that we have an available liquidity of $4 billion, which is used as a source in financing the LBO. Next, we define a working capital financing facility, which in our case is just a placeholder, as we do not have any working capital requirements with Bitter, as we already discussed in our three-statement model videos. However, we will define this facility as a somewhat short-term source of liquidity in case there's any liquidity bottleneck or short-term requirement in this regard. Next, we define the actual financing instruments. In our case, we define a senior loan and a mezzanine facility. Senior loan is structured as a plain vanilla interest-bearing loan, whereas the mezzanine facility, which is junior to the senior loan, meaning that in the case of a bankruptcy, creditors are paid off after the senior loan creditors, is structured in a different way. So as mezzanine creditors bear more risk, they have a higher return, and a further instrument to mitigate risk associated with financing are different terms. And to give you just an example, we structured a mezzanine with the payment in kind interest payment, meaning that interest expenses are repayable at maturity. More on that in a second. In addition, and to give the mezzanine creditors a future upside for the risk they are taking, we model an equity kicker that offers a participation in the exit purchase price. As always, please keep in mind that these are just examples, and in the real world there are a lot of topics to consider. To calculate the share of the different facilities, we use a pretty simple approach and assume an EBITDA multiple to assess overall debt capacity of Twitter. So we define, for example, that creditors are willing to finance Twitter up to 4 times of current EBITDA of 2022. You may think that this is pretty oversimplified, and of course you're correct. The discussions and negotiations with creditors and investors are lengthy and detailed processes, and much more information is utilized in deciding what amount and at which costs or interest these amounts are available for the transaction. We stick to this simpler approach using EBITDA as a somewhat pro forma cash flow in our model. So based on that, we calculate the share of senior loan and mezzanine, taking into account the EBITDA of 2022. The overall objective is, of course, to commit as little as possible equity to profit from leverage. Therefore, you should analyze in detail what the debt capacity of your target company is. Finally, we also include the equity kicker, which is modeled as a percentage of the purchase price in the exit scenario. So finally, we calculate the remainder to close the somewhat gap between uses and sources, which in our case is equity of the sponsor or private equity fund. As I said, the objective should be to reduce the equity commitment as much as possible to have a high upside from the leverage, and we will illustrate this effect when we define the exit assumptions. So after we define the overall assumptions of our leverage buyout and define the sources and uses, we are now beginning to model the actual LBO. First, we need to incorporate our assumptions, or better, our new capital structure into Twitter's current financial setup, meaning balance sheet. Therefore, the next step is the creation of a new spreadsheet to define a pro forma balance sheet illustrating the changes we need to apply based on our transaction. I will fast forward this process and show you the final structure, as I don't want to waste your time. You watching me typing in and formatting the cells. So after copying our overall format, we just copy the items we defined in our model spreadsheet balance sheet and link the respective figures from 2022 to the according column. Before we add another column which includes the implied changes from our assumptions we just defined in our sources and uses sheet. So here we link the corresponding items, like for example, short-term investments or liquidity we utilize in the transaction. Therefore, the negative sign. We add the financing costs, which are capitalized as intangible asset and are later amortized. Goodwill is also capitalized and later incorporated in the respective supporting schedules. Please note that our model represents a consolidated view on a potential LBO, hence the often chosen legal structures with different legal entities due to tax and liability matters are not modeled explicitly here. Next, we move on to the liability side and deduct the former financing or capital structure from the balance sheet while adding the new financial structure of Twitter. Finally, we plug in the necessary equity, which we calculated in the sources and uses sheet. So the book value of equity equals the equity from uses, the fair market value less M&A costs, which have to be deducted as a cost item affecting the net income of the respective year. After we added all our assumptions, we calculate the difference of assets and liabilities to check if the balance still matches, and thankfully it does. So next, we build the actual model covering profit and loss statement, balance sheet, and cash flow statement. For this respect, we add a blank column after the year of our contemplated leverage buyout. We will show the reason for this step in a second, but as you can see, I just highlighted the column. There's no content in it. So next, we copy the entire model sheet to create a new LBO sheet. In this newly created LBO sheet, we rename the blank column to 2020 pro forma and link the balance sheet items we just calculated in the pro forma balance sheet by taking into account the old 2020 figure plus the implied LBO changes to the respective item in the newly created LBO sheet. Regarding the LBO capital structure, we add additional lines and link the respective starting balance from the pro forma balance sheet. The former capital structure is simply deleted as it doesn't have any meaning or is not existing anymore. The future development of the LBO implied financing structure is defined in a separate debt schedule, which we will model in a second. So next, what we do is we calculate the year-on-year changes of the balance sheet item and take into consideration that we added a blank column, so therefore we have to adjust the formulas of 2023 considering the pro forma balance sheet, as you can see here. After we copied the formulas down, we jump to our asset schedules. which of course also have to be adjusted. In particular, we have to adjust all assets we touched, or all items, sorry, we touched in our pro forma balance sheet, and link the respective beginning balances to the pro forma balance sheet, as is the case for short-term investments, as well as goodwill, which is also affected through the LBO. As you can see, goodwill is rather constant over time, so we do not assume any impairment in the future. Next, we include financing costs. As I said, we capitalize financing costs as part of intangible assets, so therefore include these financing costs in the respective balance sheet item. Which are now the sum of our intangible asset schedule and the financing cost schedule. And the latter one is also amortized over the next 5 years. The assumption, therefore, is added to the respective assumption sheet. So the final step in concluding the LBO model is the definition of debt schedules. Therefore, we create a debt schedule in the assumption sheet to define interest rates, debt service, and further assumptions regarding minimum liquidity and the working capital financing used for any liquidity squeeze or bottleneck in the future. The definition of the cash reserve or cash and cash equivalents available before changes in working capital financing is similar to the definition we modeled in our operating model. However, instead of looking into the overall cash situation, we focus here on working capital financing. So what we do first is we define available cash before working capital, taking into consideration cash balance and cash flows from operating, investing, and financing, except for, of course, the change in working capital financing, which is then calculated as the negative minimum of available cash and the current working capital balance. Just one additional item I forgot to point out. So the management fee we defined in the sources and uses with 1 million is also, of course, included in our calculation here in the management fee line in the assumption sheet, which is then, of course, linked to the profit and loss statement of the LBO sheet. So after we defined the assumptions of our capital structure, we now build the respective debt schedules in the LBO sheet. For that, we add according debt schedule at the bottom of our LBO sheet. The logic we define here follows the known form. We define a beginning balance, the respective change leading to the ending balance. The change thereby relates to any debt service. In addition, interest payments are calculated as the average of the beginning and ending balance times the respective interest rate. So again, we use here the average to account for the timing aspect of the interest payment, as we do not have any detailed assumption or detailed description of when interest payments take place and how these interest payments are affected by the corresponding debt service. For a working capital financing and senior loan, this is pretty simple. We start off with the beginning balance, define an assumption in our assumption sheet, how that service looks like. As I just said, we assumed a constant debt service on the senior loan facility of 200 million, which is of course another simplification. So regarding mezzanine capital, we have to add additional lines to cover the PIK character or payment in kind mechanism of this facility. Remember, we assumed that interest payments are only payable at maturity, and therefore we need to add the respective interest payments to the ending balance or beginning balance of the following year. The interest payment is thereby calculated like the corresponding senior loan or working capital finance interest expense as the average of beginning and ending balance. In addition, we added lines for potential cash interest, which is paid throughout the year, throughout the term of the respective facility. However, as you have seen in the assumptions, we assumed that this is not the case, but you're free to play with the numbers in the future. Finally, we add up the cash interest payments, which are subsequently linked to the profit and loss statement. So this is also the final step in concluding the LBO model when it comes to the technical part. So now we have a pretty simple LBO model utilizing the flexibility of our operating model based on the assumptions we can choose. And of course, the ability to somewhat simulate LBO transactions with different parameters. The last step is, of course, to calculate the respective returns of the investors in an exit scenario. Therefore, we add an exit assumption section to our sources and uses sheet. First of all, we start off, of course, with an exit valuation that follows the same logic as our entry valuation. We calculate the purchase price using an EBITDA multiple and, of course, the EBITDA of the exit, so the EBITDA of 2027. We assume that the entry equals the exit multiple. So this means that we do not anticipate any gains from multiple expansion, meaning that the exit multiple is higher than the entry multiple. We stick to a rather conservative approach And this should be assumed when assessing an exit in the future, as the development of multiples is basically derived from the development of comparable listed companies, and hence the stock price development, and looking into the future and assuming any stock price is rather difficult. So after we calculated our EV, we of course bridge our EV to an equity value, taking into consideration debt, other items, and cash at the respective point in time, in our case 2027. So again here, please make sure that all the items which have a debt or cash-like item character are included in your bridge, and take your time analyzing the respective balance sheet on or even off balance sheet items which should be included in this bridge. So as we did in the entry valuation, we purely focus on debt and cash to calculate our equity value. In addition, we also consider any fees which are associated to the transaction and have to be paid to arrive at a purchase, or in our case, sale price. The term sale price might be misleading here, as fees are typically not part of the purchase price allocation. However, these are costs or cash outs which have to be paid by the sponsor or equity fund. Finally, the purchase price or sale price is reduced by the equity share of the mezzanine provider, which we define through the kicker. And we finally have the equity share, or the final share, attributable to the investor. Using both values, for the equity investor and the mezzanine provider, we now proceed to calculate the respective IRRs to see what each investor earned or could earn based on our assumptions. So for the investor, this is straightforward. We plug in the initial equity contribution with a negative sign, add any dividends, which is of course another source of return for the equity investor. In our case, we did not assume any dividend. However, you could also incorporate dividends in the assumption sheet as change of equity. But we, for the moment, stick with this blank line. Next, we link the purchase price attributable to the equity investor to sum up all the lines and calculate the IRR using the respective Excel formula. The mezzanine provider is treated likewise, so we link the initial investment or capital provided, add any debt or debt service or interest payment, cash payment, which is assumed to be zero throughout the term, to finally add the payback, which includes the payment in kind interest plus the equity kicker, to arrive at a total of 2.5 billion, which is then also used to calculate the IRR. Please note that here we use a different formula to account for potential mid-year payments of, or repayments of debt or interest cash payments, to finally arrive at the IRR for the mezzanine provider. So The IR calculation concludes the modeling of our LBO of Twitter. As I said, please note that the figures chosen for this video are random numbers, and as you can see, have no real-life relation. So if you look at the return for the equity investor, it's 22%, primarily based on this high sale price. In real life, the leverage we have chosen here would be rather small for private equity fund and not very attractive. But as I said, we will analyze real life figures in another video and have a closer look on the takeover by Elon Musk and to see how our model performs using real life data. But that will be in another video. Thank you very much for your interest and time. I hope you enjoyed watching this video. So please subscribe and give a thumbs up in case you got some insights to the video through the video. In our next video, we will build sales or revenue cases to finally conclude the building or the technical building of our financial model to focus more on the analysis part. If you are interested in the model and the comprehensive documentation with a step-by-step guide of the things we did today in the video, please drop us an email to the address in the video description. I'm looking forward speaking to you again in our future videos. Bye bye.